Are you an investor if you shift your assets based on an economic report or geopolitical risks? That's exactly what happened after the awful attack by Hamas on October 7th. On Thursday, after the CPI came out hotter than expected, and then again today going into the weekend with the uncertainty in the Middle East. On Thursday morning, the CPI report came in hotter than expected, just slightly, and the long bond treasuries got destroyed as the day went on. Then today, going into the weekend, equities continued to sell off while long treasury bonds went up. These types of one-day market-moving events are what I like to call news/noise events. The problem is it's really difficult to determine if the markets will continue to decline based on the news or just wiggle around a little bit before continuing higher. Let's take a look at what the metrics are telling us to see if we have any reason to worry. So, if we take a look at how the equity markets performed over the past week, you can see we had a very, very nice rally at the beginning of the week, and then things, for ARK anyway, ARK declined from that point all the way down into the close on Friday. Now, the other indices, the NASDAQ, S&P 500, small caps, and Dow all kind of went sideways and actually tried to rally back here going into Thursday morning, but then they all collapsed as well. But if you look at this, the week didn't end up really too bad. I mean, you've got the NASDAQ and the Dow and S&P 500, all the large caps finished the week higher, while the small caps and ARK Invest finished the week lower. This is very much a mixed picture, just like we saw last week, at the end of last week. And what about over the last month? Well, over the last month, again, a mixed picture. You've got the NASDAQ right up here at the top, even though it's down, followed by the Dow and the S&P, and then small caps, and then ARK Invest. So again, somewhat of a mixed picture here in terms of a healthy risk appetite. And if we look at year to date, yes, we've pulled back from those highs back here, but we still have a very healthy rally going on year to date, although interestingly enough, small caps are now negative year to date.
I'm afraid to say how I feel.
And how does all of this show up when we look at the bottom dynamics? Well, if we look at the bottom dynamics, you can see we had a very strong bottom forming indicator back here with this orange line, the bottom forming indicator up at 100%, and we had the confidence level in the mid to high 90s here. So this is a very strong bottom forming indicator. Now where are we? Well, we've come off that bottom, but now we have a bottom confirmation trying to form here. It didn't get high enough, but the confidence level was high, and then we had the pullback late this last week. So I really can't make a prediction from this where it sits right now. It's kind of hard to tell. If I had to guess, it looks like we might go lower, but I'm not confident enough to do that with this picture. And what if we look at risk versus opportunity using the old metrics? Now, we've been using the old metrics and the new metrics for several weeks now, if not a couple of months. And what's clear to me at this point is the old metrics, as you can see, are very noisy, very jagged looking. There's a lot of noise in here. I'm starting to lean toward the new metrics, which don't have as much noise. They're much smoother. And I think based on what we've been seeing, at least over the past couple of weeks, they seem more representative of what's actually happening in the markets. So maybe next week I won't show the old metrics, but let me know in the comments if that bothers you and you want me to still show the old metrics. So what do we see in the old metrics, though? Well, we see that risk acceleration is through the roof. It's up here in the high 80s. Risk, the red line, is moving higher, although it's not at a level where I'd be concerned. I'd get concerned when this gets up here above 70 like it was back here, and certainly above 80. And then the opportunity level's just kind of noodling along, not telling us much of anything. Let's contrast that with the new metrics, and you'll see what I mean about the noise as soon as I click on this. You can see that these are not as choppy. They're not as noisy. All of them are much smoother in their response. And what are these saying? These are saying that risk acceleration peaked out back here, actually before the bottom, and it has been falling ever since. It'll be interesting to see how this plays out going into next week, because this tells me we could go higher. Now, risk, the red line, which tends to be a little bit more delayed in its response, is heading slightly higher here and is above 80, which is concerning. And then you can also see that the opportunity level, while it tried to rally here, is now falling. So a mixed picture here. If you look at risk acceleration, which is kind of where are things headed, it looks like things are moving in a great direction. If you look at these two, the risk and the opportunity, these have more delay in them. They're pointing, this one's pointing down, not good. And the risk is pointing slightly higher, not good. So it'll be interesting to see which one's right here as we go into the next week or two. And what about equity versus safety? Well, let's take a look at the old metric and let's follow the NASDAQ as we always do. Okay, so if we look at the NASDAQ, back here several weeks ago, it was up here in first place, very good, although cash was here in second, not good. And then what happened? Then it fell, and then it fell some more, and then it tried to come back, and then it tried to come back some more, and then it came back some more this past week. That's starting to look pretty good. Well, what if we take a look at cash? So let's follow the money. Okay. So if we take a look at cash, cash was down here. That's fairly good. Then it moved up here. That's concerning. Then it moved up here into first place, stayed in first place for 4 weeks, and then moved to second place only because it was displaced by gold. And I'm pretty sure gold is reacting to the geopolitical risks over in Israel with what's going on there. And then if we take a look at small caps have been like a roller coaster. Down to the bottom, up here, back to the bottom, up here, down here, and now we're right back at the bottom again. So looking at just this week, this is pretty unhealthy, although the NASDAQ 100's in third place. Not too terrible, but cash and gold are in number 1 and 2, so we're not out of the woods yet. And what if we look at the new metric? Well, if we look at the new metric, the NASDAQ 100 was up here in second place, moved up into first, stayed in first. Then it just plummeted down here to ninth place, tried to come back a little bit, back to ninth. And now, just like in the old metric, the NASDAQ 100 is up here in third place. This is starting to look good, although, as you'll see when we follow the cash, cash is up in first place, so not a good picture. But, oh boy, is this going to be a fat line? It is. I did that last week too. All right, so if we look at the cash, cash moved down some more. Then it moved up and has stayed here in first place over the past 4 weeks. This is really unhealthy looking, and you'll notice that you've got short-term, short-duration treasuries, which are almost close to cash. Those are all in second place. So this is really not a healthy look. What's interesting, though, is that gold, using the new metric, is way down here in ninth place. I'm not sure what that's about, because when you look at the graph of gold, gold has really rallied here in the last week or so in response to what's going on over in Israel. Now let's take a look at small caps to see where they're sitting. So if we take a look at small caps, they were down here at the bottom, tried to move up, moved back down just like with the old metric, shot way up here, back down, and then here. So very much a roller coaster ride for small caps. And how does all of this show up in the buying and selling pressure? Well, surprisingly, given the performance this last week, you can see that for the Dow, the buying pressure, this gray line, is moving higher and is well above the selling pressure. And the Dow, in essence, has been rallying since back here. So that doesn't look too bad. What about the S&P? Similar picture, nice rally going on, even though we had a pullback here. And the buying pressure has actually been increasing since way back here. You can see that. What about the NASDAQ 100? Again, a very nice rally with a pullback, buying pressure above the selling pressure. And ARK Invest, not as good as the other ones, a rally with a very big pullback. Now we're below this previous low. And the buying pressure, though, is above the selling pressure, but is heading lower. So that doesn't look great for ARK going into next week. And what about small caps? Well, if we look at small caps, you can see they've been terrible. They've had a big decline here, although just like the other indices, the buying pressure has been moving higher until this last week when it really kind of collapsed and actually fell. It looks like it either fell slightly below the selling pressure, this orange line, or it's just at it. So not a good picture so far.
I'm chasing somebody.
Now let's take a look at sector rankings, because these give you a picture of what's going on under the covers, if you will. And the old metric, and this is the reason I want to start looking at the new metric, the old metric really doesn't give an accurate view of what's going on. As you can see, that last week we had a very, very healthy looking market here. We had the NASDAQ, Bitcoin, technology, semiconductors, consumer discretionary. Now cash was up here. Where you don't really want it there. You want it to be way down here. So this is looking really healthy, but cash was here. Now what about this week? Well, you still have the NASDAQ 100 and semiconductors and technology and Bitcoin, consumer discretionary. Cash moved down a tick, and consumer staples are way down here. So I'd look at this and say, this looks great. What about the new metric, though? The new metric, I think, is giving us a more accurate picture of what actually happened. If you look at last week, cash was way up here. Energy was up here. No surprise. And treasuries were up here. Consumer staples and gold were up here. Consumer discretionary down here. This is unhealthy. This is a very unhealthy look. And what did we get last week? Declines. So I believe this one more than the old metric. And then if we look at this week, again, same picture. Energy, cash, treasuries, although long bonds have actually moved up a tick here, which is good for long bonds. And I'll talk about why that happened later. And then consumer staples have moved up, which means things are worse, although consumer discretionary moved up a notch. But this is, again, very unhealthy looking. Now let's look at the old metric. We'll look at rank acceleration, which kind of gives you where things are headed. And now this is a little bit more accurate, right? But the problem is you still have high-risk assets up here at the top, but cash is up here, and consumer discretionary is up here, and consumer staples are down here. This doesn't give a real picture of where we were a week ago, and it's starting to give a real picture of where we are now. You can see that while cash has moved down a little bit, intermediate treasuries have moved up. They've moved all the way from here to here. Gold is at the top, no surprise when you look at the price of gold. And consumer discretionary is way down here at the bottom, but consumer staples have also kind of fallen down here. So yeah, this is more accurate. But now let's take a look at the new metric and see what that's saying. So if we look at the new metric, you can see that last week it was just sending off alarm bells. Cash, treasuries, all up here. Consumer staples up here. Gold up here. Consumer discretionary way down here. And unlike the old metric, you can see that technology, Bitcoin, ARK Invest, all the risk assets are down here, not up here where they were with the old metric. If you look at this week, it says there is some appetite for risk. Investors are putting their money into consumer staples, the safer equities. Cash has fallen back a bit. That's good. But you can see the treasuries are still way up here at the top. Now consumer discretionary also moved up here, and gold moved way down. So this is looking a little more healthy, but I'm not liking the fact that investors are really piling into safer equities. Now, they did pile into the NASDAQ 100, which went from here to here. So this is also moving in the right direction. So maybe this is better than it looks. We'll have to wait till next week and see how this looks then and see how the markets perform this coming week. And how have treasuries performed over the past week? Well, you can see what I was talking about at the beginning of this video. Treasuries had a very, very nice rally going into Thursday. Then the CPI came out and they just got wrecked. You can see that the highest risk EDV, long duration bonds, and TLT, 20-year bonds, both absolutely got trashed on Thursday. Then what happened on Friday? They popped higher a lot. I mean, they didn't make it all back, but they really moved higher and then continued higher into the close. So that looks like a fairly healthy week for treasuries, even though we had this news noise event with the CPI being published on Thursday, which caused these to absolutely get wrecked. How about over the past month? Well, you can see over the past month, they look generally unhealthy. You've got the longest duration ones at the bottom. 20 years, which are the next longest duration here, and then the shorter ones up here. But they seem to have bottomed out back here, let's say, and they're moving higher. So hopefully this will continue. And then if we look at year to date, you can see where treasuries have ended up. Absolutely destroyed here. The long duration treasuries down 23, looks like 23.32%. Move that up a bit. So if we look at right here at the bottom, if I can get it to sit there. Oh, you can't. Yeah, down 23.32%. Now understand that for that to get back to zero, it's going to have to go up 30% roughly to get back to zero. So that's a lot of upside for treasuries, which are fairly safe. And then if we look over a 5-year period, you can see that the long treasuries are down almost 40%. And just for them to get back to even, back to zero, they're going to have to go up a good, let's do the math, Calvin. So call it 37%, 1 over 0.63. So just to get back to even, these long duration treasuries, EDV, have got to go up almost 60% just to get back here to even. That's a really big gain for something that's supposed to be a safe asset. And how does all of that show up in the buying and selling pressure? Well, you can see that short duration treasuries have been the place to be. You can see that this has had a reasonable rally going on over the last 2 months. You can see that the buying and selling pressure have been switching places here. Now, recently, the selling pressure moved higher than the buying pressure, so that's not very good. What about intermediate treasuries? Well, unlike the short treasuries, these have not been the place to be. You can see they rallied back here, but then we had a pullback, and now they're trying to rally again, just like the short duration ones are. But again, selling pressure above the buying pressure over most of this time frame, especially if you include back here and all of this. I mean, the only time the buying pressure was above the selling pressure was right here. What about 7 to 10 years? These are intermediate to long duration treasuries. Well, again, tried to rally here and just absolutely declined with a little bit of a rally attempt here. But you can see the orange line, the selling pressure has been above the buying pressure the majority of this 2-month period. What about long duration treasuries? Again, somewhat of a rally here, a big pullback, and now a little bit of a rally. But again, the selling pressure above the buying pressure, except for right back here, right at the end of this rally. And what about that inverted yield curve? Well, if we take a look here, you can see that what's happened is over the past year, here's where we were a year ago, and the yield curve was definitely inverted back then. A month ago, we were still inverted, and we're less inverted today because long yields have been going higher, as you can see here. And what do the markets think the Fed's going to do when it meets on November 1st? Well, you can see there's a very high probability, 93.8%, that the Fed is going to leave rates unchanged. And that's in spite of the hot CPI report that came out on Thursday morning. And you can see there's only a 6.2% probability that the Fed will raise rates by 0.25%. So that's encouraging. And then if we look at the yield curve over time, you can see here that we were over 1% inverted back here in July and back in March before that, again, over 1% inverted. But then it's been fighting its way back. We were a little less than 30 basis points inverted here, and then it got a little bit worse over this past week. So it's going to take time. It's going to take a couple of things. Long yields are going to have to go up or not. But if they don't go up, then the only way this is going to become uninverted is for the Fed not only to stop raising rates, but to lower them somewhat going forward. And what about gold? Well, I'm putting this price chart up here so you can see what's happened. Gold absolutely tanked here. And then with all the geopolitical risk in the Middle East, you can see that it's just skyrocketed back up. So if we look at the buying and selling pressure for gold, you can see what happened here. The price collapsed back here. Selling pressure went absolutely through the roof. This is crazy. And then when the disruption in the Middle East started, you can see that the selling pressure just plummeted and the price started skyrocketing. And you can see that the buying pressure has been skyrocketing with it. So will gold continue higher? I don't know. If things continue to get worse in the world, yeah, it could go a lot higher. If things start to moderate and improve, it could drop. So we'll have to wait and see, as I always say.
of your heart.
And then what about Bitcoin? Well, you can see Bitcoin has been one of the bright spots over the past couple of months with a generally upward trend here. And you can see that the buying pressure, the solid gray line, has in general been sort of above the selling pressure, this solid orange line. And it was really shooting up here as this rallied. But now the buying pressure is falling, still above the selling pressure, but the selling pressure is coming up. So this looks fairly good. The only thing that gives me some cause for concern is how drastically the buying pressure has dropped here. But it's going to take a lot of regulatory and SEC approval before I think you're going to see Bitcoin really get out of the woods. And we're also going to need to see some very compelling use cases. Until all that happens, I don't know that Bitcoin's going to go much of anywhere.
If it's only
This past week, the markets, and especially the long bond Treasury markets, really reacted to the hotter than expected CPI report on Thursday. And then today, the equity markets sold off while long bonds went up. The big recent increase in the price of gold is telling us there's fear of the geopolitical risks with a war between Israel and Hamas. Even with all of that, the equity markets look about like they did last week. Not good, but not bad either. Like I said last week, as an investor, you have to take the long view. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
So you wanna know my name? I hope you got a lot of time. I'm not sure what you mean.